Taxes. They're probably something you only think about in April.
But in today's episode, we'll talk about how year-long tax planning can help you keep more money in your pocket.
Year-end tax planning strategies, right now on Retiring Today.
Welcome to Retiring Today. Taxes, they're one of those certainties in life, but today we'll discuss maybe some ways to look optimistically at taxes as we talk a lot about tax efficiency and some year-end tax planning strategies. I'm here with Sean Honkamp. He's a CPA, a retirement income certified professional, and a certified financial fiduciary. And this is Lauren Merkel. He is a certified financial planner, and we are going to talk today about taxes. And don't turn yet. I know sometimes when I hear taxes, I think, oh, that's not a fun subject. But Lauren, you are one of the people I know that gets excited when it comes time to talk about taxes.
Well, taxes are one of the most exciting planning elements of the retirement plan, because what we're talking about is how do you keep more of your hard-earned savings? I mean, you work for 20, 30, 40 years and you've been disciplined, you save all this money, and then you get to a point in retirement, and what have we always been told as we save through the accumulation years and then we transition to the retirement years? We have been told that we will be in a lower tax bracket in retirement. Now, for many people, that is true, but not for everybody. And we are finding an increased amount of population of retirees that is actually in the same or higher tax bracket than in their working years. So this is where the tax planning strategies are really essential for retirees and pre-retirees.
Sean, you've got the letters C, P, and A behind your name. So that means you spent several years of your career kind of recording history, and now you've changed to the retirement planning side. How do you use what you used to do to help with pre-retirees and retirees?
I started my career and spent about 5 years in public accounting, and I wouldn't take that back for anything. It just provided me with a lot of experience working with families, working with individuals, and just helping them think about this. We don't enjoy filing taxes, right? Nobody celebrates paying Uncle Sam, but it's something we're going to do every year. So that lead into what we're doing now just provided me with some of that experience, and it helps us focus on it. It's something, tax planning is something that doesn't get enough attention because it's not something we enjoy doing, but it's one of the largest expense categories that we don't really account for. So it needs to get the time and attention that warrants, trying to be as efficient as possible with our tax liability.
Lauren, people typically work with two different types of advisors as they move through the stages of life. One kind of helps them during the accumulation years, and then one helps them in the retirement years. I think what's a little bit different with what you and the team do here is you're talking about taxes in a different way than they've maybe ever talked about them before as they get closer to retirement or as they're in retirement.
There's very little tax planning that's done in this country. Most of the conversations around tax planning are these year-over-year types of conversations, meaning how can I save as much in taxes this year as possible? That's what most people, most CPAs and most people are really focused on, because nobody wants to pay more taxes this year than what you really have to. And so this is why the conversations that we have with our families from a retirement planning standpoint is probably significantly different than any other type of tax planning conversation they've engaged in. Because we're not only talking about how do we save money in taxes this year, if it's appropriate, but really we're looking at the entire retirement picture, and forward-looking, saying at this point in your retirement career, at this point in your retirement, you're going to have this income coming in from Social Security. You might have this income coming in from pension. And then once you're over age 72, you're going to have mandated income from your pre-tax retirement accounts. And all three sources of those incomes you cannot turn off once they turn on. So therefore, it gives you little control over what tax bracket that you're in, and therefore your tax situation is really at the whim of the federal government. Are they going to increase taxes? Are they going to decrease taxes? I was teaching a class this week, and I asked the question, I said, by a show of hands, how many people think that taxes in the near future are going to go up? Almost everybody raised their hand. So today, taxes are on sale. We feel like taxes are probably going to go up in the future. We have a window of opportunity to take advantage of some really significant tax saving strategies, and those are the conversations that we're engaging in as we work with the families that we engage in retirement planning with.
And Sean, what happens is that these taxes and this tax planning affects all the other pieces of the retirement puzzle that we use as guiding principles for the families here.
Yeah, the amount of taxes we're going to pay has a big impact on an income plan. An income plan is one of the key components of the comprehensive retirement plan. It impacts, the big question about, do we have enough? Right? We get that all the time, and there's so much analysis that needs to take place. We talk about it that you might have, one family could have $1 million saved, another family could have $2 million, and that situation with the family with $1 million might go further than the $2 million situation or family because of the different tax diversification that they've possibly built into their plan. And it's ultimately comes down to not about how much have saved, but how much you're in a position to spend.
And so income's one of the guiding principles, tax is one of the guiding principles, but I think it still affects the other three parts of the retirement plan.
All the 5 guiding principles are very much connected, because what you do from an income standpoint will have a direct implication of what you're going to engage in from a tax planning standpoint. It could implicate what you're trying to do from a Medicare standpoint, affect the premiums that you pay from Medicare Part B, maybe even supplemental side of it. It impacts what you're doing from an investment strategy standpoint. That's also one of the guiding principles. And then, of course, from a legacy standpoint, how much do you have left over at the end of the day to send to your loved ones, your charities? Some people have some very specific legacy ambitions, but there's not anybody that I've talked to that said, I don't care. There's not anybody that I've talked to that says, when I'm gone, whatever's left over, I don't want it to go in the most efficient way. So whether you have specific legacy ambitions or you just want whatever's left over to go the most efficient way, there is a legacy component that needs to be involved in each one of the plans.
And there are some challenges that come along with this tax planning. Lauren, your story about the class where most people will raise their hand and admit that I believe taxes are going to come or go up. There's challenges along with that, right? We've been ingrained to pay the least amount of taxes, defer, try to win the year. We talk about maybe, do you really want to win the sprint or do you want to win the marathon, right? You have to look long term when it comes to tax planning. You have to want to, over time, pay the least amount in taxes and not just focus in that 1 year.
And part of the challenge is the conflicting information that is present out there. So you talk to one CPA or one tax professional, they'll tell you, no, let's not do any tax plan. Let's not pay taxes today when you can defer them for tomorrow. You go to the next CPA and they say, well, taxes probably are on sale, now's a good time. And so that makes it really challenging as well for individuals, for you to determine what is the most appropriate for you. And that's why the retirement planning, the individual customized retirement plan, is so effective, especially when we're talking about the tax planning area, because then you can see, based on the resources that you have, based on what it is you're trying to provide from an income standpoint at point of retirement and beyond, what types of tax strategies are the most appropriate for you. Do you engage in some of the tax strategies that we're going to talk about today on today's show? Or you delay those strategies to another time? Or are none of those appropriate for you? It's easier to see that in your individual retirement plan than as opposed to just talking real high level with these professionals and categorically saying yes or no.
Okay, you guys have done a good job of setting up how important tax planning is. Let's get into some of those strategies that we want to talk with you about today. So first off, Sean, this doesn't sound like my idea of a great Friday night, but I know it's important to analyze your return from last year.
It can really turn into a really fun weekend. I think there's lots of families that...
This is a CPA talking.
Right, there's lots of families that say, you know what, we're going to pull out and dust off the tax return from last year, and since the weekend's open, let's do that. But in all honesty, though, most people get their tax return, if at all, right, and maybe they save it onto their computer so that they know they have it for future reference, and then it never gets looked at again. But there is a lot of information that can be analyzed, and it can be valuable as you think about the planning that we want to do. We have to know some about what last year looked like so that we can forecast and do some of the planning. You should want to know what your marginal tax rate is, meaning that very next dollar of income or any additional dollars of income. What is that tax rate going to be on those dollars? That's a very useful information. You want to know what you had for taxable income last year. So as you go to do that planning, whether it's with a retirement planning or with a CPA or whoever your trusted advisor is, that's pieces of information that will assist with being able to do the planning and implement some of the strategies that may fit your situation. There's other information that's valuable as well, whether or not we had capital gains or losses, things like that. So I think the big takeaway, spend some time, whether it's you looking at it, reviewing it, or bring it to some of those meetings and put yourself in a position where you have that information so that you can do the planning that best fits your situation.
When it comes to us tax planning for our families, that's one of the first places we start. We ask them for the prior year tax return because we do study it, so you don't have to. I mean, you can spend your weekend doing other things. For our families, we do study that tax return because to know where you're going, sometimes it helps to know where you came from. And what the prior year tax return does is it creates that foundation of what your tax situation, what your tax environment might look like for present year. So for present year, are your income sources going to be relatively similar? Then that's a really good start to what it's going to look like this year. Or are there going to be some differences, some nuance to this year as of the prior year? It gives us that foundation to start to make those tweaks for current year to really help us engage to determine, are we going to do some Roth contributions? Are we going to do some pre-tax or tax deductible IRA contributions, Roth conversions, all these different things or opportunities that you may have through present year.
We'll continue talking about taxes, specifically that December 31st deadline when Retiring Today continues.
Don't let 2020 derail your retirement. Join us for a complimentary workshop from 6 to 7:30 p.m. During this retirement workshop, you'll discover how to use market volatility to your advantage, tax-saving strategies to grow your retirement savings, and investing mishaps and how to avoid them in a down market. Spots are limited due to social distancing guidelines. Register now for this complimentary retirement workshop by visiting merkelplan.com.
Don't let the coronavirus get in your way of a successful retirement. At Merkel Retirement Planning, we are taking every precaution to ensure the comfort and safety of the families we work with. All visitors are seated 6 feet apart, rooms are sanitized and cleaned hourly, and masks are optional but encouraged. Retirement won't quit through this pandemic, and neither will we. Schedule your visit today.
Welcome back. Today we're talking taxes. It's not just an April event. We're talking about long-term tax planning strategies to help keep more money in your pocket. I'm here with Sean Honkamp and Lauren Merkel. And guys, we're talking about looking at your refund from last year, maybe pulling that out. But whether you look at your refund or not, Sean, I think people would like to know, is it a good thing if I owe money? Is it a bad thing if I got a return? I mean, where do you stand on that?
Like a lot of good questions, it depends, right? I mean, we have some families that look at that and say, well, geez, I got more money back this year than maybe a prior year. I felt like taxes went down. Or somebody had to pay in because of situations change and they wonder, well, why did taxes go up? When really the amount you get back or owe is just the culmination of the ultimate tax calculation with all of your information. So some families, they enjoy getting that refund back. They're intentional about overpaying during the year. They like in the first quarter of the year to know that they might get some money back coming back from IRS. Again, it feels good, right? Maybe it's a savings account that you forgot about. Other people, we see the other side, right? They want to make sure that they're not overpaying during the year. A lot of people say, well, I feel like that's a interest-free loan that I'm giving the government all year. I'm okay if I have to pay in come tax time in April. So I think the big thing is just to know that ultimately your marginal and your effective tax rate and your total tax liability, it's going to be the same whether or not you pay in more during the year or if you pay in less. So don't look at the refund or how much you owe as a final determinant of your total tax situation.
We really saw that start in 2018 because that's when we had the tax law changes. So effectively, many people were paying a smaller tax bill, but they weren't paying it as they went throughout the year. So they got less money back in the spring when they filed their return, or they had to pay in more. So it's as you were talking about, Sean, it's more about what is the total tax bill that you're paying, as opposed to when you pay it. You're either going to pay it throughout the course of the year through the withholding, or you're going to pay it in the spring when you file your taxes. But decreasing that overall amount of tax bill, or paying more in that current year so you save a lot more later down the road, that's the conversation that people really need to have as they engage in the tax planning.
And Sean, you were talking about how taxes are such a big expense for people, but for some reason we sort of just compartmentalize it as one of those expenses we have to just pay in life, which we do. We have a tax liability by law, but it doesn't have to maybe be as big as we think it has to be. Yeah,
for those families that do budget or work off of or track their expense categories, generally we start with what? We start with our net take home, and then we just go, well, I have to work from that, and we ignore this maybe biggest slice of the pie in what is our tax liability, anywhere from 15 to 40%, right, depending on your income situation and everything. So that's an expense category that it just doesn't get enough attention, right? Tax planning overall just doesn't get enough attention that it should be because of how the total bill and how much of an expense it is. We can do things that can put us in a better situation. You should be taking time to look at your taxes, do the planning, and try to put yourself in as efficient of a position as possible when it comes to determining your total tax liability.
So part of that planning is looking at all the other pieces of your portfolio and of your life that affect your taxes, Lauren. And one thing people need to consider is if they have a health savings account, how that kind of works in the tax planning.
Well, we like talking about the health savings accounts or the HSAs because they are so powerful. They're so powerful, in fact, we even have a superhero, it's a part of our superhero series that you can check out on YouTube if you want to. We have a number of different superheroes. The HSA is one of them because of the triple tax power saving effect of the HSA, meaning that when you contribute to the HSA, it's oftentimes tax deductible, which means you're not paying taxes on that contribution. So that right there alone is better than the Roth IRA because the Roth IRA is after tax, you don't get the deduction. With the HSA, that contribution grows tax-free, like the Roth, and then when you take it out, if you use it for qualified healthcare expenses, then it comes out tax-free. So you have those three tax benefits with the HSA, and the HSAs are fairly new compared to some of these other tax saving strategies, so there's still a lot of misconceptions out there on the HSAs. Not everybody is eligible for an HSA. You need to have a high deductible health care plan that qualifies you to be able to use the HSA. But if you have one, if you're eligible, and you're not contributing to the HSA, I would highly consider using that HSA and then being very strategic and intentional about with how you use that money. If you're still 10 years from retiring, what an excellent opportunity to have that 10 years worth of tax-free growth in that account as opposed to using it for your current year medical expenses. Again, it's dependent upon your situation. Everybody's situation is unique, but those are the things that we think about as we engage in this type of tax planning, current year versus future years.
We're talking about sort of what to do as December 31st rolls around or gets a little bit closer. If you haven't put money into the HSA, can you put in a lot at once, or is it a monthly contribution, or can you catch up, or how does that work?
Yeah, you can do either or. A lot of people will contribute on a monthly basis, or they'll just contribute right out of their paycheck. So you get paid, the contribution will come out of your paycheck, much like a 401k plan type savings. Dependent upon your employer. If your employer sponsors an HSA, that's easier. But there's oftentimes the employers don't sponsor the HSA, but they have the high deductible health care plan. But you can get an HSA at your local bank, or you can go to some of these bigger national custodians. It's just dependent upon, are you able to contribute to the HSA? And then however you want to make that contribution, that's completely up to you.
Okay, so taxes, not just an April event. We've talked about that a couple of times today. Year end, there's some things you can be thinking about, some things you should be talking with your CPA, your retirement planner about, and if you haven't, you might need to start thinking about, or at least want to consider Roth conversions.
Yeah, we talk about taxes being on sale, taxes being low right now. So here again, where the value of the planning, the power of the planning is to start looking at that year end income, where you're at, and understand, evaluate, is our Roth conversions a good strategy for you for the current year? As we get closer to year end, we're going to have a better understanding and idea of what total income looks like for the year. We know what the tax brackets are. That's never a secret. But as everybody admits and believes, these tax rates are going up. So let's look at where we're going to fall for income in the current year. You should be looking at, all right, how much capacity do I have in that current tax rate? People gravitate towards maybe that current tax rate and they're comfortable paying that level of taxes. So at a minimum, consider, should I be taking some of my pre-tax income, doing a Roth conversion, filling up that current tax bracket? That's where we talk about being tax efficient, not letting that current tax rate go by, because once that year is over, December 31st hits, we flip the calendar to January 1, now we're in a brand new tax year, and that opportunity has passed us by.
And that's an important note. That conversion has to take place as of December 31st. We can't wait till the spring when we file our taxes. It has to be done as of the end of that year. Otherwise, it's not going to qualify.
And some of the things that happen, in Washington or with lawmakers clearly, we know that they affect taxes, and there was a change in 2020 with RMDs.
Yeah, the change in 2020 was all with the CARES Act because of COVID-19. And what, as a part of that CARES Act, what it did is if you were otherwise required to take a minimum distribution from your pre-tax accounts or your inherited IRAs, for 2020, you're no longer required to take that distribution. So that can be a really effective way to work in some additional Roth conversions, if that makes the most sense. It can be a really effective way to be incorporated within your overall tax planning strategy. You can still engage in a qualified charitable distribution, so you can still do the QCD even though you're not mandated to take the required minimum distribution, but all those are the considerations that you should be taking into effect or into account this year.
And we mentioned earlier in the episode how there's challenge to come along with this, doing the Roth conversions, maybe taking your RMD from this year that isn't required and doing that conversion. Along with that comes the tax bill. So there's the challenge. That's the hard part, is committing to that. You're voluntarily electing to pay more tax in the current year. The reason we would do that is if you believe that over time you're going to pay less over time over the as you go through retirement. But still, it's hard to send more of that cash and pay more of that tax bill in the current year when we've all been ingrained to defer and win this current year.
It's harder, especially if that type of valuation is just a conversation and you can't really see that, and that is part of that value of that comprehensive retirement plan, because you can see what if you do a tax or a Roth conversion this year, what is the immediate impact, what is the future benefit of doing that Roth conversion versus what if you don't? What is the immediate implication? What are the future implications? And then you can see, and it becomes very clear then what strategies you should implement. Does the Roth conversion this year make sense? Does it make sense to do it at a later point, or maybe not at all?
How a change in your marital status could affect your taxes when we continue the conversation on retiring today. But first, we've got a question that came to us for our Ask the Advisor segment. Steve from Boone wants to know, if I'm already maxing out my Roth IRA, can I still contribute to a Roth 401k? We'll answer that and more next.
Don't let 2020 derail your retirement. Join us for a complimentary workshop from 6 to 7:30 p.m. During this retirement workshop, you'll discover how to use market volatility to your advantage, tax-saving strategies to grow your retirement savings, and investing mishaps and how to avoid them in a down market. Spots are limited due to social distancing guidelines. Register now for this complimentary retirement workshop by visiting merkelplan.com.
Has the recent market volatility put your retirement plan to the test? See if your retirement is still on track by scheduling a retirement checkup with Lauren Merkel. During this 15-minute phone call, we'll discuss if your retirement plan could be disrupted by long-term market volatility. We'll also analyze your current tax plan and provide strategies on how to take advantage of the market. Go to merkelplan.com and click Book Now to schedule your retirement checkup today.
It's time to answer Steve's question. Steve wants to know, if I'm already maxing out my Roth IRA, can I still contribute to a Roth 401k? Sean, what would you tell Steve?
Steve, you can. Fortunately, those contribution limits between a 401k, which are the employer-sponsored plans, and the IRA, which is your individual retirement account, are totally separate. We have up to $19,500 that we can put into a 401k. If we're above the catch-up age, we can do another $6,500, total of $6,000 or $26,000. With the IRA, $6,000 is the limit that everybody can contribute, and then we have an additional $1,000 there as well. So you can certainly fill up both of those buckets. The nice part with the 401k, no income limitations. The IRA, you may be phased out depending on how much income you have. So if you have both those available to you, make sure you're evaluating both options and contributing and saving as much as you can.
Another important point we wanted to make sure we got in today, Lauren, was that how filing changes whether you file married or jointly.
The filing tax status is one of those that's often overlooked. The odds are that if you're married, at some point one of you is going to pass away and leave a surviving spouse, which what that does is it significantly changes your tax bracket. So up on the screen, what you see right now is the married filing jointly tax bracket. And now we put up the single tax bracket, and you can see if you're in the 24% married, the income is almost half when you're single, which means that if you have the same amount of income or very similar, which by the way, most surviving spouses do, that's a misnomer as well. If somebody passes, people think that the income will get cut in half, and usually that's not the case. Because with Social Security, the lower Social Security payment goes away, and the surviving spouse gets the highest Social Security payment. A lot of times the pensions will have a survivorship, so you might receive all of that or a part of that pension. And then of course you still have the investment accounts that you're required to take distributions out for as well. So it can be a significant tax burden for surviving spouses, which is a part of that planning that should start well in advance as well.
And Sean, I think the main takeaway is if you do some planning, there doesn't have to be any surprises.
Take some time, review the tax return, think about tax planning. If your CPA isn't doing that, a lot of people kind of take, well, I have a CPA, so I'm doing my tax planning. Tax filing is not the same as tax planning. A lot of CPAs are paid to complete and file the tax return. They're not necessarily in the business of doing the tax planning. Not all of them, some of them do both, so make sure that you're using somebody to help you do the planning, look ahead, and don't be surprised.
And taxes, of course, Lauren, just one of the pieces of a comprehensive retirement plan. There's a great opportunity to learn about some more of what happens and what needs to happen when you head towards retirement.
Merkle Retirement Planning is very educationally focused, and so we have a lot of educational events that we talk about the 5 guiding principles of a retirement plan. And those you'll be able to find on our website at merkleplan.com.
Yeah, those workshops are complimentary, so you can go to merkleplan.com to check those out. We've also got, of course, the YouTube channel. That's where you can see the superhero series that Lauren was talking about, the HSA and so the Roth conversions. So we really drill down into how you can use those to supercharge your retirement. And one more thing we've got to tell you about, it's our podcast. It's called Retiring Today. So you can get your retirement information on the go. Sean and Abby and Lauren and Rochelle and I, we get together and we have some fun with the podcast and talking about retirement. And of course, we've got this show, It's Retiring Today, and we thank you for watching.
Don't let 2020 derail your retirement. Join us for a complimentary workshop from 6 to 7:30 p.m. During this retirement workshop, you'll discover how to use market volatility to your advantage, tax-saving strategies to grow your retirement savings, and investing mishaps and how to avoid them in a down market. Spots are limited due to social distancing guidelines. Register now for this complimentary retirement workshop by visiting merkleplan.com.
Don't let the coronavirus get in your way of a successful retirement. At Merkle Retirement Planning, we are taking every precaution to ensure the comfort and safety of the families we work with. All visitors are seated 6 feet apart, rooms are sanitized and cleaned hourly, and masks are optional but encouraged. Retirement won't quit through this pandemic, and neither will we. Schedule your visit today.
From our family to yours, we hope you have a wonderful weekend.
We hope you enjoy the show.
We'll see you next week.